Welcome, everyone, to The Deep Dive, your shortcut to actionable intelligence from the world's most interesting corporate reports.
Today, we are going deep on Ulta Beauty.
That's right, their Q3 fiscal 2025 earnings call, which dropped after the market closed on December 4th. And this one is a really fascinating study in contrasts.
Oh, absolutely. That tension is really the whole story here. You have this massive top-line beat, a huge guidance raise. I mean, operationally, they are firing on all cylinders.
But, and this is the big asterisk here, the stock had a really choppy reaction after hours. It popped, and then it just sort of faded.
Right.
So our mission today is to unpack that. Why are these incredible operational wins clashing so hard with investor concerns about, well, how much it's all costing?
This is the classic dilemma, right? Growth versus cost.
Mm-hmm.
To get to the bottom of it, we have to start with the results because the numbers themselves are, frankly, undeniable.
Absolutely. So let's just lay out the clear beat here. Net sales came in at $2.86 billion.
Which is a very strong 12.9% increase year over year.
And more importantly, it just blew past the consensus estimate of $2.72 billion. I mean, they beat by over $140 million. That's not a small miss.
No, that's huge. And that strength went right down to the bottom line. GAAP diluted EPS was $5.14.
Substantially beating the Zacks consensus of $4.56.
Exactly. When you beat on both the top and bottom line by that much, you know something is going right.
Okay, so here's where it gets really interesting, right? The engine behind that beat. Comparable sales. Comps.
The single most important metric for a retailer, it tells you if the core business is actually growing.
And Ulta's comps were spectacular.
They grew 6.3% in Q3. And put that in context for you, the Street was only looking for maybe 3.5%.
Wow.
And this time last year, they were almost flat at 0.6%. So this is a massive acceleration.
So is this just inflation, or are more people actually walking through the doors?
It was balanced, which is exactly what you want to see. The average ticket was up 3.8%.
Okay, so that's your premium mix, maybe some price increases.
Right. But transactions were also up 2.4%. So people are coming more often and they're buying more expensive stuff when they do. It's just a very healthy picture.
That perfectly sets up the conflict then. Pristine numbers, accelerating comps, healthy traffic. So why did the stock give back those gains?
Because the market dug into the details and found something to worry about. But before we get to that, you have to appreciate the strategy that got them here.
The Ulta Beauty Unleashed strategy.
Exactly. And the proof is in the customer base.
Okay, let's unpack that. What we see on paper is just incredible customer retention. Their loyalty program grew 4% to a record 46.3 million members.
Which is just, I mean, think about that number. That's almost the population of Spain. That is their moat.
And that loyalty is translating into digital success.
Oh, absolutely. E-commerce sales were up in the mid-teen range. But here's the really interesting part. 65% of their online member sales happened through the app.
65%.
Up from 63% just last quarter. That app is their ecosystem. It keeps customers locked in.
So let's talk about what all those people were buying. I know all major categories were strong, but which ones were the real standouts?
Fragrance was number one. It delivered double-digit comp sales growth.
That makes sense. It's that perfect, affordable indulgence category when consumers are feeling a bit of a pinch elsewhere.
Exactly. And they leaned into it. Newness from Valentino, Dolce & Gabbana, Miu Miu. They even increased shelf space for fragrance in over 60% of their stores just to get ready for the holidays.
Smart. And what was number two?
Skincare. High single-digit comp growth there.
And that's where the high-margin action is.
It is, driven by prestige names like Tatcha and Dermalogica, but also exclusive launches. Fenty Skin Body was a huge win for them.
They're also really killing it in the K-beauty space, right?
They are. They took that strength they already had in skincare with brands like Peach and Lily and just expanded it into makeup with new exclusives like Anua and Medicube. It's a really smart extension.
They launched, what, over 35 new brands this quarter, many of them exclusive? That's a ton of newness to bring in.
It is, but they're getting really good at it. Look at Sacred, Beyoncé's hair care line.
Right.
The company said it was the most successful prestige hair care launch in their history.
Wow.
And that's not just about selling a celebrity product. That's about getting a totally new customer into the store and introducing them to the whole high-margin hair care section.
Okay, so the growth story is rock solid. Now we have to pivot to the elephant in the room, the cost side.
Right. This is where the good news on gross margin runs smack into the bad news on operating costs.
So the gross margin was actually a positive story.
It was. It came in at 40.4%, up 70 basis points year over year.
Okay, a win. What drove that?
Two main things. First, less inventory shrink. So less product loss, which has been a multi-year effort that's finally paying off.
It's good.
And second, just higher merchandise margin, better pricing, more effective promos. So the core merchandising is working really well.
The operating margin, that's the headline caveat. It dropped to 10.8%. That's down 180 basis points.
And that pain point is all coming from one place, the SG&A line, selling, general, and admin costs, your overhead.
How bad was it?
It increased by a staggering 23.3% to $841 million. It's growing way, way faster than sales.
Okay.
And management was very direct about this. They're calling it a deliberate investment year.
Right, but if you're an investor, a 23% jump in overhead just sounds like bad cost control. Are they just spinning this, or is this actually a real investment?
I think it's a real investment. They broke it down pretty clearly. Part of it is higher incentive pay because, hey, they beat their plan.
Fair enough.
Part of it is higher store payroll and benefits. They're adding selling hours to improve the experience. But the big piece, the real long-term piece, is technology.
The big software spend.
Exactly. It's the amortization of all these cloud-based systems they've been building for years. The ERP, the new point of sale. They're finally flipping the switch. And all those costs are hitting the P&L right now.
So the thesis is pain today for gain tomorrow. These expenses are supposed to unlock new revenue streams.
That's the idea. Things like the UB Marketplace, better personalization, digital store stuff. And they did signal a light at the end of the tunnel. The new CFO is explicitly tasked with optimizing these costs next year in fiscal 26.
Got it. Okay, moving on from the core business, they're also scaling internationally.
They are, though it's still pretty early days.
Yeah.
They opened 7 new stores in Mexico, brought in Shakira for the launch events.
Right.
And the first Middle East store opened in Kuwait. There was a franchise deal. They had Bella Hadid there. They're showing the brand can travel.
And domestically, they're expanding their product selection without taking on inventory risk with the new marketplace.
Yeah, the UB Marketplace is a really clever play. It launched late in Q3, added over 120 new brands online instantly.
With minimal risk.
Minimal risk. It lets them play in new areas like luxury, professional, wellness, without tying up a bunch of cash in inventory.
Speaking of wellness, they're pushing into that in-store too.
A little bit. They put in some elevated fixtures in about 50 stores for brands like Therabody and Hatch. It's a clear signal they see wellness as a major adjacent category for them.
Okay, so let's tie this all together for the investor. Despite all these margin concerns, management turned around and raised their full-year guidance substantially.
Which is why the stock popped at first. The new outlook is just undeniably bullish. They raised net sales guidance to around $12.3 billion.
And the big one, EPS.
Diluted EPS, they raised it to a range of $25 to $25.50.
That is a huge jump from the old range of $23.85 to $24.30.
It tells you they believe this operational strength is real and it's here to stay.
But funding that growth costs money. The balance sheet reflects that.
It does. Short-term debt is up to over $550 million. They're using that to fund working capital and buy back a ton of stock, over $224 million in Q3 alone.
So a classic growth playbook: borrow, invest, buy back shares.
Exactly. And inventory is up 16% to support all those new brands we talked about.
Okay, so we know SG&A was a problem this year. Did they give any color on what to expect going forward? Does this margin pressure just continue forever?
They addressed that head on, and this is a really crucial point. They said they do not expect EBIT margins to get worse from these levels in FY26.
Okay, so they're signaling that this year is the peak of the pain.
That's the signal. They expect to start getting leverage on all that tech spend next year as sales keep growing.
But for the immediate holiday quarter, Q4, their guidance seemed almost suspiciously low.
Very much so. After that huge 6.3% comp beat in Q3, they turned around and projected Q4 comps of only 2.5% to 3.5%.
That seems like a major sandbag.
It feels like classic management conservatism, especially heading into the most important quarter of the year.
All right, that brings us to our favorite segment, where we take all this information and spin out a little scenario for you. And remember, this is not financial advice.
Indeed. What we have here is a company that's performing incredibly well, but the market is punishing it for the cost of that performance.
So what's the outrageous but plausible trade idea here?
The trade is to bet against that market pessimism. The market is fixated on the SG&A spend, but the guidance raise and the Q3 comp beat suggest management is deliberately lowballing the holiday quarter.
They've done it before. Under-promise, over-deliver.
All the time. So the bet is that the 6.3% beat wasn't a one-off. The holiday demand, driven by that affordable indulgence thesis, is going to be way stronger than they're letting on.
So what's the actual trade?
You go long Ulta Beauty. Specifically, you'd look at buying some out-of-the-money call options that expire early next year.
So you're betting on a big Q4 earnings surprise in January.
Exactly. The thesis is that all these growth drivers we talk about, fragrance, K-beauty, that super engaged app user, they all come together to produce another massive comp beat. Maybe they come in closer to 5 or 6%, not 3.
And a beat like that would force the market to reevaluate the whole story, regardless of the SG&A.
It forces a re-rating on the stock. You're betting that management is hiding the strength of consumer demand.
A big play based on a big beat colliding with some big caution from management. I like it.
So to sum it all up, Ulta delivered a fantastic operational quarter. It completely validates their strategy in that masstige beauty space. But yeah, the cost of all that investment definitely gave some investors pause.
Which brings us to a final thought for you to mull over. We know that their big partnership with Target, which has been a huge traffic driver, is set to end in late 2026.
Right.
Given the incredible strength we're seeing in their own stores and their own digital channels, where BOPUS is a huge driver, Ulta proved that they don't even need those external partnerships anymore. Are they finally strong enough to be a true standalone destination, cementing their place at the top of the beauty world? Something for you to think about.
Thanks for tuning in. We look forward to diving into the next stack of reports with you soon.